today we have a special guest. We have JC Daigle from Global X. He is one of the lead portfolio managers under the option strategy. So today we're going to go through an in-depth interview about what his team does and the unique investments that they offer retail clients in Canada. So JC, thank you very much for joining us today. We appreciate your time.
Hi, everyone. Thanks, Eric, for having me. Glad to be here.
Great. So we'll always just start off, if you can give us a brief introduction about your background, how you got started in the industry, and where you are today with Global X.
Yeah, absolutely. So actually, if we go back into the education side, the academic side of things, so I started off in a mathematics degree. So I'm more of a quant kind of analytic background. So I did start off in mathematics and then moved on to economics and financial economics, which kind of flows nicely into derivative products and finance in general. So after I joined Scotiabank, I was on the risk management side of things, mostly focused again on derivative products. I got the chance to then move over to front office, where I had the chance to trade options for the structured notes desk at Scotia. So that was there for 4 or 5 years. And then after that, I moved over to the ETF market making desk, where I was trading ETFs and the underlying components. So the options market actually really helped me to facilitate some of those transactions on the ETF side, and really got to see the whole multi-asset side of the ETF, which was really nice. Afterwards, I moved over to BMO, where I was a PM on, once again, the options overlay. And about 8 months ago, I joined Global X, taking care of the covered calls. And we also have a suite called the Pay Series, which is both puts and call options. So manage those as well.
Okay, fantastic. So a lot of our clients, a lot of advisors in Canada, as the demographics have shifted, we've seen a need for a lot more income for Canadian retirees and Canadians that are approaching retiree. So what I've seen across the advisors books that they manage, we've been utilizing more options-based and coverage call strategies, what you guys run. So for the end investors that are watching this, can you start with the basics and maybe just give us a brief, like, what is a derivative? What is an options contract?
Yes, absolutely. And I'll just share my screen real quick for a visual. Let me know if you do see it properly on your end. I understand that these visuals can be quite intimidating at first, but we will break it down and really try to simplify the concept for everyone to really understand and grasp the concept of the covered call fund and the covered call strategy as a whole.
Okay.
So the best way to look at it is really just split that out into two. So number one, you really break it down to your equity underlier. So what you hold as the underlying asset. So that's going to provide some growth in the future. And that's why it's also important to always keep, strong assets in that bucket or in that basket. And then when we look at the second component to it, that's really where we do our work, is on the call option side. So from there, when you look at the chart, you can see that there is no upside. There is no growth. So that is the trade-off that we provide as covered call writers. So what that means is at the beginning, once we write the call option, we receive a certain amount of premium. And at that point, we do have an obligation in the future to sell the underlying shares to the long call option buyer. In that case, we keep the premium, but then we get rid of the shares and then start all over again. And we'll go a little more into the details later on. But this is really just that visual of, part one is really that growth story, and part two is really the income generation. And then when you put the two together, you can see how you do have some growth, but it is that trade-off where it is a little less steep on the upside as if you were pure in equities.
Absolutely. So that's the key point, that there's a bit of a trade-off in that should the underlying equity rally and increase in price, you won't have as much appreciation because the main purpose was to generate an income.
Exactly. And when you look at, if you call it $1 invested in a covered call fund, for example, you can imagine 50 cents going to this equity underlier and 50 cents going to that income generation aspect.
Okay. And then so that means 50% of the price appreciation will be captured by the client.
Yes, and we call that in general. This is the example that we used for our funds. We'll talk about a little later about some flexibility that we have. But in general, when we discuss just the basics of a covered call, the 50% is really sometimes the easiest to understand and to capture.
Okay, awesome. So could you give us an example of like the actual process of writing a call, from you selecting the security that you want to write on to you searching for or setting the premium and finding the attractive contracts? Like what does it look like when your team is at your desk scanning for opportunities, and what are the steps that you go through from when you think of the decision to when the client receives their premium on a monthly basis?
Yes, absolutely. And I have another
Okay.
nice slide to share actually. This is the nice one we have here at the bottom. We say we don't chase yield, we engineer it. That's one thing
Okay.
we like to say because
We
when
can't
we
see,
go
are you showing the
into
slide? Sorry, we can't see
oh,
it yet. If
my
you are
apologies.
showing it.
There you go. Let me know if
Okay,
you
there
see
we
it
go.
now. Thank you. So right at the bottom next to the light bulb, we don't chase yield, we engineer it. So what
Okay.
we do is at the base of it all, we say what is the call it normal market environment? What are the assets that we are looking to generate income on? We look at the different vol structures or the different aspects of call options within each underlier because they are going to be a little different. And then from there, we can say how much yield can we generate on a consistent and sustainable basis, right? So we can say the average volatility is, for example, 12, 13, 14. This translates to a certain amount of percentage of yield per annum that we can generate on the options alone. So then when you add that to call it the dividend yield that you get from the underliers, if they generate an underlying yield, then you
Mhm.
add the two together, and then that's kind of the rough estimate of what we can expect in terms of distributions. And for most of our funds, we do pay them monthly.
Yeah.
So that really sets the tone for the baseline and the benchmark for what we look to achieve within that fund. And then
Okay.
after that, we can go into more details later, but the active approach kind of comes in where we have a bit of flexibility, and depending on market conditions or the other positions that we have in the portfolio at the time, then we can make the different decisions accordingly.
Okay. Okay. So I guess big part of the decision making is when writing the options is identifying a term of the contract and the appropriate strike price. Can you give us an idea of how you make those decisions?
Yes, yes, absolutely. So in the aspect of the process, so three things that we look for. One is the option tenor, one
Mhm.
is the strike price, the other one is the coverage percentage that we look for.
Can you
So
explain what those concepts mean
yes,
briefly?
for sure. So the option tenor is really the maturity of the contract that we're entering. So when we do sell a call option, usually if you follow the theory, they say 45 to 60 days is really the optimum value to write an option on, and that's just because of the underlying model and the derivatives off of those. So for us, what we target is closer to the 30 to 45 days. Because we don't write a single option, we really ladder it out through different maturities. So what we like to do is, for example, if we write 25% of the coverage needed on a weekly basis, or sorry, on a monthly basis, then you
Mhm.
have a staggering where every week you have maturities for the
Yeah.
options. So it's a little less concentration risk. It's a little smoother of a process for the underlying return of the whole fund. So that's
Okay.
kind of the approach we take from the option tenor. A little less flexibility there, but we really kind of stick to that 30 to 45-day window as much as possible. The
Okay.
second one that we look at is the strike price. And the strike price is really, if you look at the option contract as a seller, we have the obligation to sell the shares, the underlying shares, at a certain strike price at maturity. And that strike price really determines how much growth you allow your shares to grow before they get called away, for example, in a bull market. Right.
Okay.
In a bear market, for example, you keep that premium, but as the shares go down, you don't get called away, and you can rewrite new options and pocket that premium initially.
Okay.
And
Okay.
on the third aspect would be the asset coverage side. So for us, we typically look at 40 to 50% coverage. So that means for every dollar of asset that we hold, we
Mhm.
would cover 50 cents of that, or 40 cents, right, for the 40 to 50 range. So that
Okay.
also is the call it second major lever in the trade-off of income and growth, right? So the first one is the strike price, how much do we allow the underlying to grow? And then the
Mhm.
second one is how much of those assets do we cover? So on a 50% coverage, for example, in a bull market, half your portfolio will continue to grow while the other half will get capped off to generate
Mhm.
that income.
Okay. And speaking of income that's generated, I guess can you explain how volatility in the markets plays into determining that premium? Because what people say is that in a more volatile market, options premiums can be better. Is that true, or is that not the case?
Yes, it absolutely is the case. Implied volatility is really one of the major parameters of options pricing. So
Hmm.
as the higher volatility occurs in the market, as the higher they get priced into the options market as well, the more premium you can collect from that. But
Hmm.
once again, there's always that trade-off of income versus growth.
Yeah.
In the case where the implied volatilities do increase, well, chances are the market might have sold off a little bit. So
Yeah.
that at that point, the trade-off becomes, yes, you can pick up more premium, but you'll be capping it after it has sold off, right? So higher volatility for us doesn't necessarily mean more premium, but it just means more range for us to play with the strikes. So do we want to keep picking up the same amount of premium? Do we want to pick up more? Do we want to leave more room for the upside? Do we want to really cap it down here? So those are or I guess what we look at when we make those decisions. The implied volatility, the higher, it makes our jobs a little bit easier in a way, because it does open up kind of the parameters of the options that we can write. When volatility is low, then that's a little more troublesome because then we're stuck in terms of the strike or the tenor selection. So a little more constraint in that. So.
Okay.
Mhm.
I think when a lot of end investors hear volatility, they think risk, right? And could you talk about the risks of writing options? Like what's I know losing upside potential could be seen as a risk, but what are the risks that you guys are evaluating when you're making your decision and risks that you're trying to mitigate or avoid?
Yes, exactly. So when we think of risk in the options market, everyone thinks of, you know, maximum risk or unlimited losses and things like that. So for us, because we have that trade-off between holding the underlying stock and writing that call option, a lot of that risk, a lot of that leverage gets taken out of the product. So
Hmm.
for us, it's really useful to generate that income without necessarily taking on more risk. So for us, one of the risks that we look out is downside risk, right? And that's why the quality of the assets are important, right? If you remember the slide from earlier where we have 50 cents in the growth, 50 cents in the income generation, well, that 50 cents of growth, you are exposed to that downside, right? So you want quality assets. Index-based assets are good, or
Hmm.
nice wide variety, diversified baskets are good as well.
Diversified,
Um,
but okay. So diversity, we always talk about diversification and baskets. So in a typical strategy, is there an ideal amount of underlying securities that you would want to keep? Is more better or is less more efficient?
in the covered call space, there is a bit of a sweet spot. Diversification is great when you have a mass amount of assets or a number of underliers, but then that
Hmm.
becomes quite difficult to manage operationally from options perspective.
Yeah.
So for us, we would focus, 20, 25 names is really a nice key number because it really targets good diversification at the same time, not too much effort on the operational side, but
Hmm.
also focus in on maybe the better vol names or certain names that have better options markets. Not all of the underliers that we trade, for example, in an index would have an options market
Hmm.
or a liquid options market. So
Okay.
depending on the size of the fund or the size of the underliers that we trade, it is something that we have to look at.
Hmm. And from my understanding, the biggest and the best options market is the United States, the US market. Can you give people an idea of how the difference between the US market works, the options market compared to maybe the Canadian options market?
Absolutely. In the US, like you mentioned, it is the biggest, it is the most liquid. For us, anything we need to transact in the US, there's no problem. There is no size constraint. We're not big enough. Our funds are not big enough for that. You can do, billions of dollars in the US, no problem.
Hmm.
In Canada, especially the options market in Canada, can be a little more challenging.
Yeah.
Um, we also see the trickle-down effect of our options positions into the underlying equity markets as well. So not only the options market we need to take into account in terms of liquidity, but also the underlying equity markets as well. Because if they can't sustain the liquidity of the options,
Hmm.
then we're going to run into some situations.
Okay.
So that's always one of the aspects that we look at. And also another thing that we look at is the bid-ask spread in options. right? In the US, it's fairly tight. On the Canadian side, it's quite wide. And that's why we have to have good relationships with our brokers and really
Hmm.
negotiate those pricing and get the best or get the optimal yield for the fund.
Okay.
Just as an example, if you take a bid-ask spread of a Canadian option, you can almost see a 5% call it per annum difference in the bid-ask, right?
Yep.
When you look at compounding or yield-based. So you can see that how it can make a big difference in terms of, executing yourself or having kind of call it a professional or someone, an expert in the field to execute those for you.
And you know what? I was going to get to that point. I wanted to ask that question later on in the interview, but now that we're here, let's talk about that because what we're seeing is a lot of people, there's more interest in individual investors trying to write their own options, right, on the stocks that they own. Could you go over what you think the risks are to individual investors, compare and contrast that to working with a professional team that has size and scale and a network? Because I don't think a lot of people realize, how much they may be missing out on pricing if they're trying to do it themselves on a relatively small position.
Yeah, exactly. And then that difference between Canada and US is massive when it comes to pricing.
Hmm.
We discussed a bit in terms of the quantifying that bid ask or the
Yeah.
liquidity aspect of options. Just on the day-to-day operational side of things, someone to manage their own covered call, for example, would have to, make sure that they follow everything from X dates, earnings, option assignments that come through, any terms of liquidity events that happen in the market, corporate actions, right? Those can get very tricky when it comes to options. Any mergers, acquisitions, stock and cash, and those will have impacts in your portfolio. And really staying on top of those can be quite tricky. So for us, the covered call funds, I would say they're quite cheap. So paying the 40 bips to manage all of that operational aspect, to really maximize or optimize the pricing that we get,
Hmm.
because we fight for every basis point, right? So
Yeah.
um, and that's kind of what matters in the end. Yeah, and really, that trade-off of incoming growth, right? We've have experience with that. That's what we've been, working with for the last few years. So,
Hmm.
we're well ingrained in it, and someone who's starting off, you can definitely get it done, but it definitely won't be optimum. And at that point, your 40 bips that you would pay us, for example, to do that,
Yeah.
would save you a lot in the long run when, 5% is the bid ask in options, for example.
Yep. And the harder to quantify is the time savings, right? Trying to manage this on your own. Can you, how many people do you have working on your team right now?
We have three actually right
You have
now.
three of you. Okay.
Yeah, exactly. But we also have an extensive reporting suite.
Yep.
Everything is, Python based. We have databases. Everything
Hmm.
is nicely automated and connected. So without
Hmm.
that infrastructure, it would be quite difficult to manage
Yeah.
all the funds that we have.
And you're
So
also
that's definitely a
working
big
on
asset.
the infrastructure as Global X as a whole, where you have your research analysts from maybe different divisions, and you've got very high-end exclusive data too, right? Which would be very hard for a individual investor on a part-time basis trying to compete with. So I
Exactly.
can see the risks about that.
And just to add, actually, the many hours of back testing and testing out new strategies
Yeah.
and looking at the different role aspects, there's constantly changing markets that we have to stay on
Hmm.
top of, and it's not
Hmm.
just sector based, but also just the option model as a whole. So that's really something that we have to keep working towards and optimizing every aspect that we do, and that's from monitoring all of our
Hmm.
trades to at the end of the day just trying to always do what's best, right? So. Um,
That's an interesting point. Can you explain how back testing works?
Yes, that's a very tricky subject, actually, especially
Okay.
in the options world. Data is quite hard to get in the options space, and it's quite expensive as well. So anytime you do back testing, it's not only just back testing the strategy, but really going down to the individual rolling aspect of it. A lot of it goes down to how are you executing the roll? The role being, as you have one option that is in the money, and then it comes to maturity. Well, you don't necessarily want to sell the shares. So what you do is you buy back that option and then write another one. Right. So that's what we say by roll.
Hmm.
So those rolling days or those rolling Fridays become quite intensive, and also we want to really maximize every price aspect. So the slippage or transaction cost really comes through on those Friday rolls, and trying to optimize those through back tests, through scenario analysis really goes a long way.
Okay. And are there any misconceptions about the options market that people from the outside have? That they hear derivatives and options, and I think a lot of people may automatically assume it's a high risk strategy. But how would you give a overall risk analysis on what it is that you guys do?
The overall risk analysis on our side would be fairly low compared
Hmm.
to, I guess, what the optics is.
Yeah.
Anytime you do deal with options, yes, there is leverage, yes, there is excess risk. But
Hmm.
how we do manage these portfolios, it is all under control. It is managed. It's
Hmm.
also under the framework called NI 81102, which is a regulatory framework where, it limits us exactly on that, on leverage, on coverage, making sure that we're not, have naked option positions on anything like that. So that risk is very well managed within the shop here.
Hmm. And for people watching, a naked option would mean you're writing an option without actually owning the underlying investment, the underlying company. You guys are
Correct.
doing covered options where you own the investment, right? Because there's a lot more risk in writing an option on a stock that you don't even own, correct?
Exactly, yes. And that's where that unlimited loss potential comes in, right? If you're naked or you sold that call option and that, underlier goes to infinity, well, you
Yep.
are down infinite amounts of money, right? So that
Wow.
is your unlimited loss. But because we do hold the underlier and we only
Hmm.
cover, for example, 50%, if the stock does go to infinity, well, we make infinity profits on one side and then cut it off by half on the other. So we
Okay.
still, make good money in the end.
Yeah,
So
and
you want to
infinity is a
participate
tough loss to
always.
handle. That would
Yeah.
make a lot of people uncomfortable. You,
No,
you mentioned
exactly.
leverage. So are you using leverage in all of your strategies, or certain mandates have a leverage component to it?
So our covered call suite does not have any leverage in them. We do have another suite that's called the lightly levered suite. So what
Hmm.
that does is it applies 1.25 leverage to our covered call suite. So it just enhances the premium and allows you to participate a little more on the growth side
Hmm.
as the market does rally.
Okay.
So that's a
Can you?
different option, but less for advisors and more for retail clients. So
Yep.
it could be up the sleeve, yeah.
Can you explain how leverage works and how that amplifies the returns?
Yes. So in this case, what we do is straight cash borrow. So
Hmm.
we take 25% of the value of the fund, we borrow
Hmm.
cash, and then from there, just invest more into that covered call. So
Hmm.
for every dollar that we receive from the client, we're invested 1.25
Hmm.
in the covered call. So for example, if let's use USCC as an example, which are S&P 500 covered call fund. Right now, that the yield on it is 10%. So the lightly levered would be 12.5%.
Hmm.
And then it also participates more to the upside. So on a total return basis, you'll see a little more growth,
Oh,
a
wow.
little something that looks a little more like the actual equity itself versus the covered call that has a little more capping.
Okay. And how does that increase the yield payout to clients when you use leverage?
It's really just an enhancement of what we're already doing on the covered call side. So right now we're generating the 10% on the covered call fund.
Hmm.
Therefore, since you're owning 1.25 of that 10%, then you just get that 12 and a half naturally through
Okay.
the
So you
same
go.
distribution schedule, just really
Mhm.
1.25 times more.
Okay, great. So you go from 10% to 12.5%. Simple idea. And the
Mhm.
distributions, we focus a lot in our practice on tax efficiency. And for the distributions, I'll let you talk about it on the call options premiums are all capital gains,
Correct, exactly. So they
right?
are tax efficient
Hmm.
compared to other income generating type assets, especially on the fixed income side where they're taxed as income. Yes, it is a big advantage. And also, you do keep a portion of the equity in your portfolio.
Yep,
So you don't have to give up a whole equity sleeve just to generate income. You can have both in one.
absolutely. And are you writing put options in these strategies as well, or is that a different team that does that?
So same team, but completely a different set of funds. So the
Yeah.
covered calls will be strictly the call options. The
Hmm.
pay series suite is where we do the put writing and the call writing. So
Hmm.
we call that kind of the wheel strategy, or right where we sell puts,
Yeah.
generate the premium, and then from there, if the market does come down, we get assigned on those puts. We can hold them up until the rally and then exit on the way out through call options. Therefore, you
Hmm.
pick up premium on the way in, you can ride the stock and then premium on the way out. So a very efficient way to distribute capital.
Okay, so two completely different mandates.
Two completely different mandates,
And
correct?
what's the difference between writing a call and selling a put? What's the different perspective on the underlying to do such a thing?
It would be going the opposite directions in
Hmm.
a way. So when you're selling a put, you're going to long the stock or long the underlier. So you are bullish in that sense. If you are
Hmm.
selling a call option, it is technically a bearish position. But given that you hold the long stock in a covered call, it does offset nicely. While for us on the put writing side, we do have, so our funds on the put writes are TLT based, so fixed income based.
Hmm.
So it does give us a little more comfort that it's not going to go to zero. So writing puts is a little more comfortable with that. And then, yeah, and you can also generate a little more premium on the downside. Just the
Okay.
natural, call it, I don't want to say skew of the curve, but the natural tilt of the volatility surface
Hmm.
on the downside allows you to pick up more premium as the vol will be a little higher on the downside than it is on the upside.
Okay. So would you say for investors wanting to use a call option or a put option strategy, the call option is to get price appreciation and generate income, and the put option strategy is to add downside protection and generate income, or does the put option serve a different purpose?
So since we're selling the put option or writing the put option,
Yeah.
so once again, we have that obligation to buy the underlier if it comes below our strike. So
Hmm.
at the end of the day, it is not necessarily for protection, or it is not for protection because you want to buy a put option for protection.
Okay.
Since we're selling it, we're going the opposite way. We want to get long that exposure. In the case of the TLT, so when we think yields are coming down and we think the bonds are going to rally, then we're going to sell those puts.
Hmm.
And if the timing is not right and bonds come down a little bit below our strike price, we can buy those bonds to then hold them. And as the bonds rally, sell the calls and exit on the way out through that strike price.
Yeah.
So it's a two different type of strategies.
Hmm.
But the put writing is quite tricky. And I would say, mostly on the index side, it's a little better. On the single stocks, it could get quite dangerous, right? Because some stocks can go to zero, and if you're
Yes.
writing put options, then you have the obligation to buy that stock. So,
Buy the
um,
buy a lot buy something for not that's worth nothing, right?
yeah,
That's a tough pill to
exactly.
swallow. Yeah.
Yeah.
No, there's a lot of
So,
complexities in the options writing strategy, and in our practice, we're utilizing more of these strategies for retirees, right? And I
mhm,
think as a diversifier, we can use the strategy for people in the growth stage of life, but for people that are transitioning and want to preserve more of their principal, live off the income, you guys offer a really good suite of products to help our clients reach their goals. And it was great to get an insight into like the complexities of these strategies rather than trying to go at it yourself and having a really seasoned team of money managers look after the chunk of capital. So
mhm.
JC, those are all the questions that I had today. Wanted to wrap it up. Appreciate your time, appreciate your input. It's been a pleasure talking to you. So once again, thank you very much.
Yeah, thanks, Eric. Thanks for having me, and
Okay,
don't hesitate to reach out.
awesome. Thank you.